Your view on A shares has, of course, been lackluster, apart from the pop that we saw on Friday, is that you're going to see a market rebound in the second half of the year. What is underpinning that view for you, Jun Li?
Yeah, we are still positive about the market. We are positive about the rest of the second quarter, and we are looking positive in the second half as well. So there are a few drivers for this. One is that China-Asia market already corrected a lot since its peak in February 2021. So CSI 300 index went down by about 16% from its peak. So it's a significant correction. After the correction, the valuation reached a relatively fair value. So CSI 300, for example, current P is around 17 times, close to 2-year average of 16 times, and slightly higher than the 5-year average. This compared to 3 months ago has already been very fair. And even compared to the developed market, we think the China-Asia market valuation is relatively attractive. Also, more importantly, we think the underlying growth remains intact. We see very strong earning growth for the first quarter 2021. Arguably, this is because the first quarter 2020 had a low base. However, looking into the rest of the year, we still believe that earning growth is likely to be 15%. Some of the sectors are going to have pretty good earning growth. So given all of the three factors combined, we are still positive at this phase.
Where exactly are you focused then, given that positive bias that you're seeing, Jun Li?
Yeah, I think investors need to stock the sectors that have cooler growth trends. Let me just review, for example, the sectors that are less impacted by the PPR rate, but more on the fact that they can pass on the cost to their consumers. So this includes the consumer staples and consumer discretionary sectors. We are also looking to the industrial sectors that have very clear secular growth trends, such as the solar industry, such as the electric vehicle industry that have seen very strong growth globally this year, and the value chain in Shanghai in China is very likely to benefit from that. Also, we are mentioning that we can also look into some of the sectors that has low valuation, such as the banks, etc. These sectors are going to benefit from the underlying growth of the economy, and also they are traded at very fair value.
Jun Li, I want to just expound on that point around the banking sector here, because the longer-term trajectory, it seems, from economists for China's growth picture is that you will see a slowdown in growth there. So how do you match that picture with the opportunity that you see in banks?
Right. So if we're looking at the banks, the underlying drivers are a few. Of course, it's the economic growth. I think after the recovery from 2020, the leverage situation of most of the companies in China and enterprises in China has been improved. The second key drivers for the banks is really about the spread of the interest rates. So with the potential of rising interest rates, we think the banking sector is likely to benefit from that as well.
And do you like any of the big tech names here in China at this point?
Of course, people talk a lot about the regulatory risks about the tech names. We see for a few cases, for example, Alibaba paid a fine, and also Alibaba, from its latest earnings calls, indicated that it's going to use all its incremental profits for the fiscal year 2022 into the business expansion as well as merchant support. We believe that it's a result of the antitrust regulation tightening as well as more intensified competition. I think these are the overhangs of the big tech names in China for now. However, we want to highlight that despite the regulatory overhang, the businesses of the leading tech names such as May.16 and the contributing Tencent are very solid. So despite the uncertainties, investors could look into the longer-term growth drivers and start to considering buying into the stocks when the prices are in a relatively low range.